We are now going to discuss the accounting equation and do some transaction analysis. The accounting equation is assets equals liabilities plus equity. In our case, it'll be owner's equity. This is the basic accounting equation. We'll expand upon it more in a moment. First, let's discuss what each of these items mean. Assets are resources a company owns or controls. This is our stuff that the business needs to have in order to make sales. You, as a person, have assets. What would your assets be? What is your stuff? Here are some examples of some assets that you may have: a car, a house, your clothing, furniture, computers, phones, TVs, other electronics, and cash in your bank account. Now, let's go over assets that a business would own. They have cash, supplies, equipment, building, automobiles, and furniture as well. A lot of these are similar to your assets. Another one that businesses have that we will be dealing with a lot over this course is accounts receivable or receivables. A receivable is when we are owed money. We're going to receive money, which is why it's called a receivable. For now, we're going to assume that if anyone owes us money, that they will pay us. We will learn in a later chapter what happens when they don't. After this video, at the bottom, I have a link to a chart of accounts. This is from the textbook. I did remove some accounts that we will not be working with at all in Accounting 1. Here's a list of assets you could potentially be using throughout this course. To begin with, some of the ones that we're going to use starting off in the first few chapters would be cash. Here's your accounts receivable that I was just talking about. We have supplies. Here's our bigger items such as automobiles, trucks, furniture, equipment, machinery, building, land. The rest of these we're not going to use quite yet. Next, we have liabilities. Liabilities are creditor claims against our assets. These are our debts and obligations. This comes from borrowing money. What are your debts? Some examples would be student loans, a mortgage if you own a home, your car if you financed it, your phone or computer if you're making payments on it. Do not confuse liabilities with your expenses. I have a lot of students who think that items such as an electricity bill, for example, would be a liability. That is not necessarily the case. I didn't borrow any money. My bill comes in, then I pay it. It's an expense, which we will talk about more later. Now, if the bill comes in and I don't pay it right away, then I will owe money and then it's a liability. There's a difference between paying something and owing on something. Now, for businesses in accounting, we call liabilities payables. Going back to the chart of accounts, we'll see some common liabilities right here. Whenever you see a payable, it's a liability. See how these all end in payable? Some examples of liabilities that we will be working with are accounts payable, notes payable, which is down here, salaries payable. An account payable is when you have purchased materials or inventory from one of our suppliers and we did not pay yet. A note payable is like taking out a loan. We owe money and interest is involved. We will deal with this in our last chapter. For now, these are the most common ones. Remember, this is us owing money. If we owe on our insurance, if we owe interest, if we owe on our salaries payable, office salaries payable, that's if someone worked for us and instead of paying them right away, we're going to pay them maybe in a few weeks from now. Now that's a debt. We owe something. Rent payable would be if we owe rent for the future. Some of these other ones we're not going to get to for a few chapters from now. Lastly, we have equity or owner's equity. In Accounting 1, we were only looking at small businesses, not large corporations. We will look at accounting for large corporations in Accounting 2, where these account names will be different. Equity is the owner's claim on assets, or net assets. Equity increases through owner investments and revenues. It decreases through owner's drawings and expenses. This is sometimes a tricky topic to understand. I like to rearrange the accounting equation to explain this a little bit better. Instead of assets equals liabilities plus equity, I moved liabilities to the other side. So now it's assets minus liabilities equals equity. The equation does still work. But let's say I bought a car for $25,000. I put a $5,000 down payment on the car. Therefore, I owe $20,000. So I have a car right now that's worth $25,000. I put $5,000 down and I have a loan for the other 20,000. My car is an asset. It is worth $25,000. The loan, that's my payable, that's my liability. I owe $20,000 on the car. When I subtract the two, I get $5,000 as my equity, which makes sense because that was my down payment. Out of the $25,000 worth of assets that I have, I only own $5,000 of it because the rest is my debt. That is why equity is also called net assets. It's a portion of my assets that I own. We are going to expand on owner's equity more next. This is the expanded accounting equation. We still have assets on one side equaling liabilities, plus we're going to add everything that makes up equity. We're going to still have our equity, but we're expanding upon what is part of our equity. Equity includes capital. Owner's capital is the owner's investment in the business. If I put my own money into the business, my capital account will increase. Each owner will have their own capital account. For example, mine would be Kroeger Capital. Now, all these next items affect capital. First, it's withdrawals. This is when the owner takes money out of the business for personal use. This could also be the owner paying themselves for work, such as taking a salary. If my business made $200,000 this year, you better believe I'm going to take out some of that money to pay my bills. This brings me to my next 2 points, which is revenues and expenses. Revenues are the gross increase in owner's equity resulting from business activities entered into for the purpose of earning income. That's the definition for it. Your revenues would be your earnings from your job if you're looking at, what your revenues as a person would be as an individual. A business's revenues are from selling a product or service. These are its sales. Expenses are the cost of assets consumed or services used in the process of earning that revenue. What would your expenses be this month? Sure, it's utility bills, food, gas, any of these other payments that you have to make each month. A business has similar expenses. Some examples would be a utility expense, which would be your heat, your electricity, gas, water bills. A phone expense, salary expenses to pay its workers, rent expense, and so on. Here's a chart of accounts again. Here are the revenue accounts. We can always call it sales revenues, revenues, whatever business you're in. Ocean County College, they get tuition revenue. If you sell a product, it could be sales revenue. For me, it could be accounting revenue for an accounting firm or consulting revenue. We can really just name it whatever type of business you have, whatever your sales are, or however you're earning money. The rest of the accounts we're really not going to deal with quite yet. Now I have expenses. There's a whole list of them, and we can have even more expenses depending on what your business is. Some of the common ones we'll deal with right from the start would be like our salaries expenses, insurance expense, rent expense, the supplies expense we'll talk about in chapter 3, advertising expenses, repairs, telephone, utilities expenses. Those are some we're going to look at right now. The rest of them we're going to save for later chapters. The difference between your revenue and expenses is your net income or loss if you lost money. A business will add up all its sales, then subtract all its expenses to arrive at net income. We will talk more about this in the next video. When our business has income, it will be added to owner's capital. Then the owner can withdraw it out if they want to, or they can keep the money in the business to grow the business. Sometimes the concept of equity can be really confusing. So if you are a little confused, that's okay. This is only the first lesson. Usually by chapter 4, students start to understand it much better when we close the accounts into capital. We now have a few classwork questions to work through. The first one is number 3 on your classwork. Remember to fill yours out and follow along. We're going to use the basic accounting equation to fill in the blanks here. You can pause this video now and try part A on your own. We have the basic accounting equation here. Assets equals liabilities plus equity. So remember, everything here on the asset side on the left side has to equal everything here on the right side. If assets equal 75,000, then we know over here has to also equal 75,000. What would liabilities have to be in order for this side to equal 75,000? It would have to be 35,000. 35,000 plus 40,000 equals 75. So we have 75,000 on both sides. The next one, there's a blank for assets. We know liabilities is 25,000 and equity is 70,000. What would our assets be? We add these together, we get 95,000. 95,000 equals 95,000. Lastly, 85,000 equals $20,000 plus whatever our equity is. What does our equity need to be in order for both sides to equal? It would need to be 65,000. Now we'll have 85,000 on both sides of the equal sign. Part B is the expanded equation. We have assets equals liabilities plus capital minus withdrawals plus revenues minus expenses. Once again, you should pause now and try this on your own. We have assets on the left side equaling 40,000. Therefore, we know that everything on this side here needs to equal 40,000 as well. We have 16,000 already, plus 20,000, minus 8. What does revenue need to be in order for this side to equal 40,000? It would need to be 12,000. If you do the math, 16,000 plus 20,000 minus 0, plus 12,000 minus 8,000, we will get 40,000. What about for the next one? We don't know what withdrawals are. We know one side equals 80,000, and this side will also need to equal 80,000 as well. Withdrawals will need to be 2,000. 32,000 plus 44,000 minus 2,000 plus 24,000 minus 18,000 will equal 80,000. Next, we have number 4 on our classwork. Identify each of the following items as assets, liabilities, or equity. Once again, you should pause right now and try these on your own. Part A, land. Would that be an asset, a liability, or equity? You can always refer to your chart of accounts too if you need some help on this. Remember, land is something we own. This is part of our stuff. If we own it, it would be an asset. B, owner's capital. Remember, capital is part of equity. It would be equity. C, equipment. What do you think this one is? Remember, equipment is our stuff that we own. We need equipment in order to make our sales. This would be an asset. What about accounts payable? Remember, anything with the word payable means it's a liability. E, accounts receivable. This is us going to receive money. Someone owes us money and we're going to receive that. Remember what I said? Accounts receivable is an asset. And lastly, F, we have supplies. Supplies is also an asset because it's our stuff that we own. It'd be a very good thing for you to get familiar with all these different types of accounts and what category they fit into. Next, we have number 5 on the classwork. Identify each of the following items as either a revenue, an expense, or a withdrawal. You should pause this now and try this on your own first. A, the cost of sales. Remember, this is a cost to us. The cost of making sales, this would be an expense. The rest of these are pretty easy. Service revenue would be a revenue account. C, wages expense would be an expense account. It has it right in the name. D, owner withdrawal would be a withdrawal. Remember, withdrawals and expenses are different. Withdrawals is the owner taking out money for personal use. An expense would be for the business, a business expense. E, rent expense would be an expense. F, rental revenue would be a revenue account. G, insurance expense would be an expense. And lastly, H, consulting revenue would be a revenue account. This was pretty easy, and I hope you got these ones all correct. We're going to move into something a little bit more difficult now, a transaction analysis. Enter the impact of each transaction on individual items of the accounting equation. We have 5 different scenarios that happened, and we need to fill in the chart here. First, we have part A. The company completed consulting work for a client and immediately collected $5,500 cash earned. We completed consulting work and we got paid money. We have to think what 2 accounts are going to be affected here, because we always have 2 accounts that are going to be affected in order to make the accounting equation still equal. Remember, we have assets on one side and then liabilities and equity on the other side. And I put a few specific account names in here, such as accounts receivable and accounts payable. By the way, this is how we list accounts receivable and payable. We do an A/R and an A/P. So it means accounts receivable, accounts payable. Now, we got cash, right? We got $5,500 in cash. Why did we get cash? Why did someone give us money? It's because we made a sale. That would go under revenues, 5,500. The accounting equation works as everything on the left side of the equal sign needs to equal the right side. 5,500 on the left side equaling 5,500 on the right side. Next, we have part B. The company completed commission work for a client and sent a bill for $4,000 to be received within 30 days. This is different from part A. We did work in both of these in part A and B. In A, they paid us right away, and B, they're going to pay us later for. Instead of receiving cash now, they're going to pay us later. What account do we use when someone owes us money? Remember, that's accounts receivable. So in this case, we did do consulting work, so we have earned our revenue, but instead of receiving cash, we have an account receivable. Someone will owe us money. In this case, instead of cash going up, accounts receivable will increase by $4,000, showing that we are owed this much. Why does somebody owe us money? Because we made a sale. See how revenues increased for both, but it's different over here. The accounting equation still works though. 4,000 on one side, 4,000 on the other. And then I have this darker blue line where we add everything up, 5,500, and then add up, this column is just 4. I have 0 for these accounts. Add up the 5,500 and 4,000 to get 9,500, and we have no expenses. This is just to make sure everything on the left side equals 9,500. Everything on the right side also equals 9,500. Next, we have part C. The company paid an assistant $1,400 cash as wages for the period. What 2 accounts are being affected here? For one, we're spending cash. Our bank account is going down. We're losing cash. Why are we spending cash? What's it going towards? It's going towards paying one of our employees, the assistant. It's going towards the salaries expense. So in this chart here, you would subtract $1,400 from cash because it's going down in value. And on the other side, we would put into expenses 1,400. The equation still works because this is negative 1,400 equals minus 1,400 here. So it's also negative 1,400. Now in chapter 2, we're going to be doing journal entries. We wouldn't just call this expense, we would call this a salaries expense. We would be a little bit more specific. But in terms of just getting you started here, we'll just group all expenses together. Now we're going to have to total these up on this darker blue line. We had 5,500 in cash. We just spent 1,400. So now we have 4,100. Just bring everything else down because nothing happened. 9,500 comes down, and now we have expenses here of 1,400. Part D. The company collected $1,000 cash as a partial payment for the amount owed by the client in transaction B. In this case, we are receiving cash. Why are we receiving cash? It's because in part B, we made a sale and someone owed us money. They owed us $4,000. We put that in as account receivable. Now they're paying us some of that. Do they still owe us $4,000? No, they only owe us $3,000 now because they're paying off $1,000. I'll show you how this is done in the chart. In this scenario, we are receiving $1,000 cash because they owed us money. The accounts receivable of $4,000 now gets reduced by $1,000 because they no longer owe us the full $4,000. Nothing else gets touched here, but the equation still works even though it's all on the same side. 1,000 minus 1,000 is 0. So this still works. Let's total everything up. 4,100 plus 1,000 is 5,100. 4,000 minus 1,000 is 3,000. And this makes sense because our accounts receivable, we are owed $3,000 now. They paid off 1,000. The rest are zeros for now. And then revenue, we'll just bring that down. Same thing with expenses, just bring it down. Okay, last one. In part E, the company paid $700 cash for this period's cleaning services. What's one account that's affected here? Cash, right? We are spending $700 cash, and what are we spending it on? Cleaning services. What would cleaning services be? It would be an expense. To fill in the chart, we would subtract $700 from cash, and we would input $700 into the expense column. Negative 700 equals negative 700. Now let's total everything up. 5,100 minus 700 is 4,400, plus 3,000 equals 7,400. Now this side has to also equal 7,400. We have 0 in these accounts. 9,500 minus 2,100, that's the total of my expenses, equals 7,400. The equation still works. I know this can sometimes get a little confusing, but we're not going to be using this whole chart and transaction analysis after chapter 1. This is just to help you get started thinking about the different accounts that will be affected and how it affects the accounting equation. Starting in chapter 2, we're going to move directly to journal entries, and you won't have to fill in this chart. If you need practice, look below this video. I have other videos from the publisher and some things to look at for practice with this.